Hello, you sweet and spicy people. Today we're talking about FHA versus USDA loans and which one is going to be the better one for you. Because if you choose the right loan, you're actually going to see a savings of around $40,000. So if you stick around till the end, I'll show you actually a chart breakdown between three different types of loans. So we'll do 2 USDA loans, 1 FHA loan, so you can get an idea of which is going to be the best option for you. And while you're here, go ahead and subscribe, like this video, and we'll dive into this. My name is Kyle with winthehouseyoulove.com, and let's talk about an overview between these two loans first. So, just a quick background is these are government loans. So there's traditionally 4 main types of loans. There's a conventional loan, FHA, USDA, and VA. We're going to talk about these 2 main government loans here. So you do not have to be a first-time buyer with either of these loans. A lot of people think you do, especially with FHA, because it's more advertised to first-time buyers. And these are government-sponsored, they're government-backed mortgages. And what that means is basically anybody who purchases these loans on the secondary market actually has insurance provided by the government in case of a default. So long story short, what that means is these are safer loans for investors because they have this government backing to them. Also, they can only be for a primary residence. So if you are an investor, this is not going to work for you, unfortunately, okay? These are only if you're going to live in the property and you need to live in there for a minimum of 1 year. Now, USDA is a little bit different than FHA because it's technically a loan for rural properties, but it's not for farms or mixed use. Okay, so it can be a little bit confusing here, but really, an FHA is a standard loan that's going to work in all of the U.S. USDA is only going to work in rural areas, and we'll talk about the map with that as well. But FHA, kind of an overview, it's mainly for low credit scores, buyers with credit issues, and it's a lot easier to qualify for than most other loan programs. USDA has no down payment. It's for rural areas, and there are actually 2 different types. Okay, there's direct and guaranteed. In this video, we're only talking about USDA guaranteed. Guaranteed is what most lenders can offer you with a USDA loan. Direct is directly through USDA, and that's more for low income, and there also is some subsidy that you can get with that program. It's also a lot more difficult to qualify for, and again, only USDA provides it. No other lenders can, but USDA guaranteed, which we're talking about in this video, a lot of lenders can provide this for you. So, credit score requirements right off the bat. FHA has a minimum of 500 as a credit score, and so does USDA as well, okay? The minimum goes pretty low compared to conventional's 620 minimum credit score. Now, the one weird difference here is with USDA, if you have a 500 score, you can do 0% down. With FHA, if you have a 500 score, you have to do 10% down. Once you get up to a 580 score, then that's when you can do 3.5% down on FHA, which is the most common down payment that people see with FHA. With USDA, the minimum is 500 for 0% down, but ideally you want to have a 640 because 640 allows you to use GUS, and GUS is USDA's underwriting software. And basically, this is something that you'll never interact with, and most of the time people don't even know that their loan has been underwritten through GUS. But basically, if you have below a 640, you have to do a manual underwrite. That means it's going to be a lot more difficult to qualify for a USDA loan if you have less than a 640. So lower debt to income ratio. So you won't be able to afford as much house. But if you have a 640 or higher, you can have access to this underwriting software, which allows you to get approved for more through USDA. Now let's talk about these rates here. Rates between both of them are actually going to be very similar. Anytime I've priced out the difference between these 2, they are the exact same rate. Now, lender to lender, they might be a little bit different, but you should be seeing very similar rates again because they're government backed. And you're going to see best rates at 640 plus. There seems to be this bracket with government loans. When you hit a 640, all of a sudden you're going to see better interest rates. And brokers tend to have better pricing and better rates on government loans than maybe some other lenders would. So it's absolutely worth getting a quote from a broker. And the reason why is actually because the difference with the laws that are created specifically around brokers that don't constrain other types of lenders. And this makes sure that brokers actually have to pass on savings to you legally, where banks don't have to. So long story short, brokers tend to have better rates on these government programs like FHA and USDA. That being said, let's go into a quick word from our sponsor. So our sponsor is Credible. They're a mortgage comparison website. What you can do is go on their website with the link in the description and fill out a form. It takes only a few minutes. They'll do a soft credit pull, so it won't affect your credit score. And then you can see all of the rates that you're pre-qualified for from different lenders and compare them to find which is the best option for you. So it's easy, it takes only a few minutes. Something to know is Credible does pay Win the House You Love an advertising fee if you do fill out a pre-qualification form. And again, that's Credible Operations Inc. NMLS 1681276. And that link is in the description if you want to try that out. Okay, now let's talk about credit events. So both of these loans are actually really lenient on what we call credit events. And so these are things like bankruptcies and foreclosures. So these things that can trip you up a lot through the loan process. So FHA and USDA are very similar, and they're actually pretty much identical in what they allow for credit events. So both on a Chapter 7 bankruptcy, you're going to wait 2 years from a discharge. Chapter 13 bankruptcy, you need 1 year of on-time payments and a court approval. Okay. Foreclosure, you need to wait 3 years from the deed transfer date. Okay. And then also for both of these, you're going to want to have no major derogatory credit in the past 12 months. And derogatory credit would be something like a 90-day late or multiple 60-day lates. Okay, if you have one 30-day late, maybe 2 30 days late, most lenders are going to be able to approve that for you on FHA and USDA. But if you start getting into more than that, that becomes major derogatory credit. It's going to be a lot more difficult for you to get approved with those late payments. Okay, now let's talk about debt to income ratios. So this is going to directly affect how much house you can purchase. Okay, so let's first talk about FHA. So FHA has a front end ratio of 36.99%. And a front end ratio is basically your gross income monthly times the front end ratio is how much housing payment you can have directly. Okay, and so let's say we had a $70,000 per year income. That would translate into a max housing payment of $2,157. On USDA, the max front end ratio is almost 34%, which translates into a max monthly payment of $1,982. So we can see the difference here in price and how much we can afford. It's about a $15,000 difference in purchase price between these two programs. So if you need a little bit more wiggle room, then FHA is probably going to be your better option to get approved for more. And then you also have these back-end ratios. The back-end ratios are your new housing payment plus the amount of debt that you have. So FHA is a lot more lenient if you have higher credit or if you have higher debt that you're trying to fit in your debt to income ratio monthly. Okay. Now, loan limits. FHA has a loan limit lookup tool, and that link is going to be in the description. So there are loan limits based on the county, and there are high cost areas. So it's pretty standard across most, I would say 90% of the US, but then you do have some of those higher cost areas that do allow you to get a higher loan amount with these FHA loans. And then USDA does not have a loan limit, which is awesome. The only downside is they have an income limit, and we'll talk about that here in just a little bit. Okay, now on to down payment and closing costs. So with FHA, a 500 credit score and above, you need 10% down. A 580 credit score and above, you need 3.5% down as a minimum. On USDA, 500 credit score and above, 0% down. So this is really great if you're trying to save money on your down payment. If you don't want to put a down payment down, USDA is going to be your best option here. Now, both of these loans do have a form of upfront mortgage insurance, and this is actually wrapped into your loan amount. So FHA charges 1.75% in what they call upfront mortgage insurance premium. USDA charges 1% in what they call a funding fee. And both of these, most of the time, are wrapped into your loan. So for instance, on an FHA loan, let's say you had a $100,000 loan, it's actually going to turn into $101,750. Okay, USDA, if you take out a $100,000 base loan, your total loan is actually going to be $101,000 because of the funding fee being financed into the loan. Okay, so the higher your loan amount is, the higher those amounts are going to be that are financed into your loan amount. So it's something you have to be careful about here. And then all other closing costs are going to be normal. So with these loans, you're still going to run into the standard things that you'll run into on all other loans. So you have your appraisal, your title fees, you have taxes, insurance, recording fees. Those are all going to be the exact same with every single loan. And keep in mind that USDA, even though it says 0% down, that's 0% down payment. You still have closing costs. So you still will have to bring money to the table if you're paying for all of your closing costs up front with a USDA loan. So just be careful about that. Seller credits. So both these loans have a max limit on how much you can ask the seller for in credit to pay down your closing costs. And this is 6% of the purchase price for both of these. So if you're purchasing a $200,000 house, you can ask the seller to pay up to $12,000 towards closing costs. Now, the likelihood of your closing costs ever being $12,000 is very far out. Most of the time, you're not going to run into closing costs that are that significant here. Now let's talk about some special requirements and features. So FHA is most known for having the ability to partner with down payment assistance programs. And these programs tend to be local, on a local level, so you'd have to find those around your area. But FHA is the most lenient program in allowing down payment assistance to help you with your initial upfront costs when purchasing a house. USDA is a little bit more tricky, okay? A lot of people don't know about USDA, or they're just afraid of USDA because it has some of these little quirks that we have to watch out for here. So the first thing is there is a location limit. All right, so again, in the description is going to be the links for all these programs and all the details of them, but USDA is only for rural areas, and they determine this by population size. So it doesn't mean it's only for farms, okay? Because USDA actually doesn't work for a working farm, which is kind of confusing. It's only for rural areas. Also, there's an income limit for a household, okay? And it tends to be around the upper end of the median area income. So normally what I see is somewhere around $80,000 to $90,000, and this is household income. And the household part is a thing that trips up most people because it's your household as a total. Let's say that the limit is $88,000. If your household, anybody above the age of 18 combined is making more than that, then you're not going to be able to qualify for that USDA loan. So this is where you kind of have this weird mix of there's no loan limit, but there is an income limit. And so that kind of puts an artificial loan limit of sorts because you can't purchase a huge home, still fit into the income ratio while being under the income limit. So most of the time, USDA homes will probably go somewhere around the $300,000 range, near the upper limit. You might be able to squeeze in a little bit more, but that tends to be pretty common for what I see being the top end of USDA, where FHA can go a lot higher in some of these higher cost areas. A huge benefit of USDA that so many people don't even realize is there's one way to wrap closing costs into the loan. Now, before the housing crash, there used to be programs where you could wrap closing costs into seemed like any loan, and that's actually what kind of helped lead to the housing crash. USDA actually still allows this provision in kind of an interesting way. So let's say that you purchase a home for $200,000, but it appraises for $205,000. Because the appraisal is higher by $5,000, you can actually wrap it up to $5,000 of your closing costs into your loan amount. And this is only if the appraisal is higher than the purchase price. And this is the only loan program that does that. But most people don't even know that this exists. So it's something great to keep in mind. Again, we talked about this before. There is guaranteed versus direct. Direct is only through USDA, and it's going to be a lot longer of a process, a lot more complex, but it is for low-income households. Versus guaranteed. Guaranteed can be offered by any broker, bank, credit union, direct lender. It can be offered by anyone. And then USDA, people get kind of tripped up with USDA because there is a commitment review, which is kind of confusing because what has to happen is your mortgage lender is going to approve you, but then that's not the end of the story. They actually have to send that loan to USDA for their review. And then someone at USDA has to actually audit the file, look through it, and then issue a second approval. They're basically kind of auditing the file to see if it meets USDA standards, which can be a little frustrating because there's actually a turn times on this. And you can look this up. You can Google, Ohio USDA turn times and see how long it takes. In a normal market, this might be somewhere around 2 days. In a crazy market like we're in right now, I've seen this take up to 10 days, sometimes even 2 weeks for USDA to issue their commitment on these loans. So basically the lender approves you, then they send it to USDA, then USDA approves you, and that's when you have your final clear to close. So that's one little weird thing with USDA. With FHA, you have FHA approved underwriters who have the ability, and I don't know if it's technically a certification, but they have the ability to sign off on that loan being clear to close, where USDA, it has to be sent to USDA. It's a dumb program or dumb process at least. So with the appraisal standards on these are both the same for the most part. The government programs, USDA, VA, FHA, have stricter requirements than conventional does because they're government backed. So they're mainly concerned with health and safety, structural soundness, protecting the property value. So the best way to think of it is think of something that's going to be move-in ready. That's going to be the best for both of these types of programs, FHA and USDA. Again, they're stricter than conventional because they're government backed. So examples of things you need to watch out for would be broken glass, chipping paint, plumbing issues, exposed wiring, broken or damaged HVAC systems, rotting wood, and a wet basement or crawl space. Those are very common issues that I see. The most common one is chipping or peeling paint. I can't tell you the amount of appraisals that have come back needing repairs done just because there's chipping paint. It's not that hard. You just sand it, repaint it. Okay. But I see that tripping up so many appraisals, and then what has to happen is you have to repair it, and then have an appraiser go back out, and they have to charge a final inspection fee, which is normally somewhere around $150 to $200, just to check that work was done. Okay, so save yourself the hassle of that. Make sure those things are completed. Now, both of these loans do have mortgage insurance, and for the most part, they're going to stay on there for the life of the loan. With conventional loans, you're going to see mortgage insurance drop off when you hit 20% equity. So let's talk about FHA first. So FHA has 0.85% yearly mortgage insurance. So on a $300,000 loan, that's $212 per month. Okay. And then they also charge 1.75% upfront mortgage insurance, like we talked about earlier. So on a $300,000 house, that's $5,250 extra. So make sure you keep this in your mind when you're using a program like this, because you immediately took an additional $5,000 fee that FHA charges and put it into your loan simply for using this loan. So when you need to go sell the property, that has to be paid back, okay? Because it's in your loan amount now. Or if you pay it till the life of the loan, you're going to end up paying off that $5,000. So just keep that in mind, that it does increase your loan amount quite a bit. And then FHA does have this rule that if you put 10% or more down, that mortgage insurance will fall off after 11 years. Okay, it doesn't do the 20% equity like conventional loans do. But if you do the minimum down payment, or if you do less than 10% down, mortgage insurance is going to stay on for the life of the loan unless you refinance it into a conventional loan and you have 20% equity. USDA is 0.35% yearly insurance, which is $87.50 per month. You can see this huge difference here between the mortgage insurance costs of both of these. Also 1% funding fee, so on a $300,000 loan, $3,000. And this stays on for the life of the loan. Even if you do put a down payment on, doesn't matter what you put on. You can do a 20% down payment on USDA. You're still going to have mortgage insurance, and it's going to stay on there for the entire duration of the loan. Now let's talk about seller perception, because when we're using loans, we have to keep in mind how the seller is going to perceive us using that loan specifically, right? So FHA loans are seen as slower than conventional, and it's really not that true. FHA can be a little bit slower, but with both these loans, FHA and USDA, I've closed both of these loans in 10 days, okay, from start to finish. So they don't always have to be slow. Appraisals are also kind of seen as a pain because they stick with the homes for 4 months. And they have all those requirements that we talked about earlier that are more strict than conventional. So with it sticking with for 4 months, if you get an appraisal today and let's say it comes in short, the seller can't have another FHA buyer come in and get a new appraisal for another 4 months because that first appraisal value will stick there for 4 months. USDA is kind of seen as uncommon by a seller, so they might be a little bit more hesitant to want to go with an offer that has USDA unless their agent explains it to them well. So knowing that these loans are both perceived as a little bit worse than conventional or slower or more of a process than conventional helps you realize that if you're going to put in an offer with one of these two loans, it's absolutely can still get accepted. Okay, we see tons of offers accepted with FHA and USDA. You just have to make sure that the rest of your offer is attractive. Okay, maybe more so attractive than if you're putting in a conventional offer. So this is usually seen as slower than FHA due to the commitment review, right? Where the loan gets approved and then it has to get sent to USDA to get approved a second time. And again, the appraisal can also be a pain and it also sticks with the property for 4 months. Now, let's talk about a loan comparison because I think it's interesting to actually look at these numbers because when you're trying to figure out, you can put all this information in your head, but it's hard to actually figure out, which one do I want to go with? So what I did is I pulled up a $262,000 house around our local area to pull in some of these numbers. So here's a monthly cost snapshot here. So I have 3 different types of loans. I have an FHA loan, it's 3.5% down. I have a USDA loan, that's 0% down. And then I have a USDA loan that's 3.5% down. And the reason I did that is because that's a more fair comparison against the FHA, because it's not fair to compare one loan with a different down payment than another loan, right? Because we change the loan amounts. So of course, one's going to be cheaper. So this helps us give a more fair comparison between the two types of programs without the down payment factor. Okay, so FHA total cost would be $1,823, USDA $1,750, USDA 3.5% is $1,708, and these are all monthly costs here. And here's the cost breakdown. So we can see principal, we can see interest, we can see mortgage insurance and homeowners insurance, and then we can see an estimate of taxes as well. So FHA tends to have a higher monthly payment because of that higher mortgage insurance that is on the loan there. Now, I think the best way to actually see the numbers here is a total cost snapshot over 30 years. So again, we have the FHA 3.5% down, USDA with 0% down, and then USDA with 3.5% down. And we can see over a 30-year period, the cheapest loan is USDA with 3.5% down compared to the FHA loan. All right, and this difference here, we can see FHA, how much more costly it is. The difference between FHA and this USDA loan is $41,386. That's a huge difference, especially considering the USDA loan had a cheaper monthly payment and we're saving $41,000 over the life of the loan. And the difference here between doing 3.5% down payment on USDA versus no down payment on USDA is only $5,800 over 30 years, okay? So really, a USDA loan can be a fantastic option if you're wanting to put 0 down and still come out with a good loan program. The only issue is you're just going to have a lot of a tighter box to fit into, right? You need that rural area. You need to be under an income limit. The property needs to meet these requirements. You need to fit under the debt to income ratio limits. It can be a little bit more difficult to qualify for. If I was going to choose between the two, personally, I would go with the USDA option if I was able to fit into all of those criteria. So if you can fit into all those boxes, USDA is most likely your best option. It's going to save you the most money and provide the most flexibility here. If you can't, FHA is a great runner up. All right, so I hope this helps you get a good idea between the two of these loans. So if you want to learn more about conventional versus FHA, this video over here is going to help you learn just that.